Good morning, everybody, and welcome to our webinar this morning. I've started to or set up the title as The World at Our Feet, mostly to indicate, I think, the optimism or the opportunity that we have at the moment, given where we are, where we're looking at our new government of national unity. The markets have started to feel a bit more positive about the direction of travel that we're in. And the world really is at our feet, and it's up to us to make the most of that opportunity. Before we really get going, I'd want to just have a look at how we got to where we are at this point in time. The journey we've been on for some time as an economy and as a country. And if I look at our economy, our global economy, as with any economy, it moves in cycles up and down. We have our good times and our bad times. And you can see typically from this picture from the IMF, going back to the beginning of 1980, how the global economy has ebbed and flowed over that time. We've had some periods of extreme positive growth, and then there's been times of quite stark recession. If we look at those little icons I've put in there, if we go back to the aftermath of September 9/11, that recession we had 2001, 2002, it was a little more shallow compared to the recession that we got, the Great Recession that followed the global financial crisis, and then also the big sell-off and economic decline that we had during the times of the COVID um, virus spreading around the world. So those are quite marked recessions, but generally economies move in cycles as we see there. And the advanced economies, those that I've highlighted, or that the IMF there has highlighted in the chart in that bluish color, those typically grow at a slower pace. They've been around for longer. They've had more of an opportunity to develop, and it's much more difficult for those economies to grow at higher at higher growth rates. They need to continue to really excel to get higher levels of growth. In contrast, the emerging markets, or those that are still developing, they still have lots of opportunities to grow off a low base, and that's why you see emerging markets, that level of growth is typically higher than your advanced economies. And the world then, if you throw it all together, somewhere in the middle of all of that. So we've ebbed and flowed and gone in those cycles. And at the after the COVID recession, we have seen the economy, the global economy, slowing down. We've cut growth rates, or we've contracted. Well, we haven't contracted, we've slowed down to this point over the last 3 years. And if we look at the expectations then going forward, we've got the World Bank at the top there and the IMF at the bottom, both of them indicating more of a stabilization now in global growth rates. Those institutions measure growth just slightly differently, but the outcome and the picture is the same. We've got the World Bank in the top half of that slide showing us leveling out at growth of 2.6% at a global level, similar or exactly the same rate of growth as last year, and then looking to 2.7% growth for the next 2 years. So in their words, global growth stabilizing at this point in time. The words of the IMF in their latest outlook, which was in April, and they'll update that in July, but they're looking to steady but slow was the title of their last economic update, and they're looking for slower levels of growth, but then also stabilizing. You can see their version of global growth at 3.2% last year, this year, and next year. So the message there quite clearly that maybe the slowdown is coming to an end, and we're bottoming out, stabilizing at these lower levels of growth for the global economy. Our own economy not to be outdone, also follows in cycles, and being part of the global economy, being an open economy that participates in this global economy. Very visually there you can see our economy moving up and down along with the rest of the world. We have our own different story to tell, but we are part of the global economy. If you go back to the earlier parts of that graph that go back to 1980, where we were more of a pariah on the global stage, before our democracy, our new democracy kicked in the mid 90s, we were much more an isolated economy. We had global sanctions, and perhaps there you can see not as much of a correlation with the rest of the world until that 94, 95 period where we were welcomed into the global economy, and we became part of that economy to a greater degree. So one takeaway here, though, is that our level of growth, as you can see in the green line there, has been lower most times than the global level of growth. Been in sync, but at a lower level. When we compare ourselves to other emerging markets, our growth rates have also been lower. We are comparing ourselves maybe unfairly to the likes of China and India that have been growing at more recently levels of 5-6% plus. But going back to those headier days, even of China growing at 10, 11, 12, 13% GDP, we have lagged, but those emerging markets in totality or in aggregate, those growth rates above our own level or pace of growth. If we look at what we've managed to achieve over the last 30 years, going back to the start of our democracy, we had that honeymoon period where we were welcomed into the global economy, back onto the global stage. We ourselves were full of optimism. There was investment into the economy. Our debt levels were low or improving, and we could grow at levels there of 3-4% back in those days. And then ahead of the World Cup, again, we had this global event. We were all excited about it. It required a significant amount of investment into the economy, and there we were growing for a number of years above 5%. And that just shows what was possible. We did then have the global financial crisis, the recession, the Great Recession that followed. We were sheltered to some degree by the stability of our own banking system, but in essence, we did have a year of contraction then. But as I say, much better, or to a much lesser degree than the rest of the world. And then we go back, after that, our growth rates really slowed from the 3s to the 2s to the 1s to even less than 1%. And then we had that bit of distortion with the COVID recession, the recovery after that. So we had a big decline, a big recovery, but then we've gone back to business as usual, unfortunately, with growth rates less than 0.7% at the last reading, but less than 1%. On a quarterly basis, we did get our Q1 GDP growth rates the other day, and that highlighted or reflected that our economy actually contracted in the first quarter of this year. If we look at the high frequency data, it wasn't any surprise. The mining sector contracted. We get the manufacturing data regularly. That also showed a contraction in the first quarter. We know from the retail sales that household consumption is quite weak, demand is quite weak. And it was probably only really the agriculture sector that prevented it from being an even bigger contraction in the quarter. Agriculture only really makes up about 2% of the economy, so a very small part, but it is prone to very big swings up and down. and on this occasion it was a lot more positive. So as I say, that helps. It was a positive contributor, but not enough to overcome the negative growth in the rest of the economy. So you can see there on a quarterly growth rate level, also very subdued over the last quarters and over the last couple of years. If one just looks at how our economy has moved along, this picture from Statistics South Africa just showing the absolute level in real terms of our gross domestic product, what we produce within the economy, and this is on a quarterly basis, where we are in that first quarter that we've just reported is almost identical, just a few billion more than we were back in quarter one of 2020, just before the recession hit. So we have not managed to substantially grow this economy, for a number of years. The outlook is also quite subdued, and there I've leaned on the growth forecasts from the Reserve Bank, from their Monetary Policy Committee meetings, just highlighting their expectations of growth there above 1%, but less than 2% for the next 3 years. So that is, certainly not the level of growth that we would hope to achieve. We certainly, with our economy and the level of unemployment that we've got, we would want to see growth rates substantially higher than that for a sustained basis. But that's where we are at this point in time and the immediate outlook. Having had a look at the growth picture of the global economy and our own level of growth, we can look to another part of that economic coin, the other side, around inflation. With the war that we had, or the invasion of Ukraine by Russia, we started to see there's some impact on commodity prices, energy prices in particular. Coming out of the COVID recession, China was very slow, that economy, to get going, and that hampered production of a lot of the goods in China that's demanded by the rest of the world, and that absence of that production created issues in the supply chain, and that lack of availability pushed up prices as well, and that took some time to right itself. We're still waiting for the Chinese economy to actually really hit its straps again and get going. But ultimately, those supply constraints, the concerns around food security with that invasion of Ukraine just pushed up food prices. We had higher oil prices, and all of that increase in energy prices, food prices, was felt around the globe. We saw inflation increasing to levels not seen for many decades. In this picture, I've got some developed market economies, the inflation rates there. You can see the grey line in the UK, inflation moving above 10% in the latter part of 2022. We had Eurozone inflation also above 10%, US inflation above 8%. From the world's biggest economy, that was a substantial level of inflation, and as I say, a high level that we haven't seen for many decades. That inflation rate was, or that higher global inflation, was also felt in Japan. They have their own particular circumstances there, but this is an economy that's had deflation for many, many years, for decades even, that resulted in interest rates in that country being at zero for decades as well. So we even saw inflation coming into the Japanese economy, and all of these four highlighted economies have a 2% inflation rate target. That's a point target that they're trying to achieve. And after that big spike up in inflation over the period of 2021-2022. We've seen an improvement in inflation. We've had deflation for much of 2023 and into 2024, but that deflation has slowed, and it's only the UK there that you can see that grey line that's actually now achieved its or for the first time at the earlier part of June when we got this report from them that they achieved their 2% target for the first time in many months. Those other global economies, or you can see the blue line there, the US economy, inflation has slowed, but it's been pretty sticky and very hesitant to move lower to that 2% level. And that had implications for US monetary policy. And in the Eurozone there as well, it got close to 2, but just not quite there just yet, but there or thereabouts, but a little bit sticky. On the local front, we weren't alone there. We weren't moving away from the rest of the world. We felt that same level of inflation. We felt that same energy prices hurting our economy, food prices as well, being a big importer of a lot of commodities. We felt that as well. And you can see that dark blue line there, our headline CPI over 2021 and 2022, kicking up to a peak there in July of 2022 of 7.8% before some deflation kicked in, and we saw, or let's say disinflation, we saw a slower pace of inflation to the point that our latest reading at 5.2%. So we have a 3 to 6% target range. That 5.2% still above the midpoint of the range, and still uncomfortable for our Reserve Bank. If we look at our core inflation rate, that's the lighter blue one there, the last reading at 4.6, that is much closer to that 4.5% midpoint. So heading in the right direction. And I'll highlight shortly the outlook from the Reserve Bank for our interest rates going forward and their expectations of inflation in the coming quarters. But still, our headline CPI at 5.2, still not where we'd like to see it. The response from central banks to all of that rampant inflation was to ratchet up their policy rates. Their response, as I've highlighted, was swift and severe. You can see those very frequent increases in interest rates. The green line is the South African Reserve Bank's repo rate, and even though I've highlighted the developed economies in the lower part of that graph, we were amongst the first there in the global economy to actually start putting up interest rates in response to this inflation. But the movements were quick and fast and frequent, and we got to the point then again where we were at levels of interest rates last seen before the global financial crisis. So this is quite a long time ago, and those levels of interest rates have been sustained now for some time. If we look at our own repo rate, that green line on the top there, we've been there for just over a year now at a level of 8.25%. So we've had sustained high interest rates across the globe for some time. I highlighted the inflation that has come through into the Japanese economy for the first time in a very long time, and that's enabled them to actually increase their interest rates for the first time also in decades, to be slightly positive at 0.1%. On the European front, given their view that inflation is close to the target range, and they want to start seeing, they want to start normalizing interest rates, they have made their first rate cut earlier in June as well by 25 basis points. So we take this, the growth rates that we've seen, the inflation rates, the interest rate response, and on top of all of that, we've had the complexity of much of the world, a large part of the world, depends which what you're reading, but 50 to 60% of the global population actually going to the polls this year. And voting and general elections and presidential elections have been the stuff of headlines for much of this year. We're seeing the debates in the UK between the Prime Minister and the potential newcomers. We're looking very likely to a change in government there to Labour. They're certainly leading the polls. In the US, we've got presidential candidates also, having their debates and looking, very threateningly like a return of Trump back to the White House. So all of this just highlight, we've had our own elections. India have had their elections. All of this very much a time of politicking and really maintaining or trying to stay in power, stay in government, and in a bit of a sideshow when these economies need to be looked after and driven. We need policy to be maintained. We need an eye on the ball, and this is something of a distraction while they play out. In our own economy and in our own country, we've just had our elections. We're in the aftermath of all of that, and we still have to see how it all actually ends up in terms of who's in government, who's in the cabinet, who's doing what. But a lot of excitement that we potentially dodged a bullet there with some of the more extreme parties getting into positions of power. I think many of those people will still be sitting in parliamentary seats, but with a government of national unity, we can potentially see something more centrist and maybe a lot more checks and balances. We don't have one dominant party in power, but we have more inclusive opportunity here to govern, and as I say, more checks and balances. We have had the market did get excited when Cyril Ramaphosa was elected president the first time. We've now sort of experiencing something called Ramaphoria 2.0. It's that same bit of deja vu, and we ask ourselves, will it be different this time? When I was typing in Ramaphoria here, my autocorrect wanted to change it to Ramophobia. So we're sitting in that position of trying to think: is this going to be an exciting prospect, or is it something a little more worrisome? The markets have initially told us that, or shown the view that things could be quite positive. Our equity market jumped. We almost got to a new closing record. This is just the equity market in this year. We got very close to the January 2023 high, above 80,000 on the FTSE JSE All Share Index. So the market responded positively. We saw a lot of the South African incorporated stocks, the banks, the likes of a Bidvest, very close to the local economy, all jumping on the day or two after it became apparent that we were going to get more of a government of national unity. The bond market really shot the lights out. That graph there on the bottom shows the yields to maturity of the government's bond maturing in 2032. Kind of look at it as a 10-year benchmark bond, but it's more an 8-year bond these days. But the yields on that moved dramatically, well over 100 basis points, just highlighting the excitement and enthusiasm around the prospects of where we can go as an economy if we all work together. and what that would mean for growth and ultimately for our markets as well, and international perception of our economy and then our markets too. So that was the immediate response. I think at this point in this juncture, we're looking at on a day-to-day basis how things are going to play out with the central banks around the world, and ultimately when are they going to lower interest rates. Growth has slowed. Inflation has moderated closer to target levels. So the market is quite expectant that we will see lower rates from these central banks, and now pretty soon. We've lived and are living from inflation print to labor print to any little piece of economic data, particularly the US data, and there's virtually an economic print every day that has relevance for US interest rates going forward. But we look at those numbers and the market interprets sometimes good news is bad news and sometimes bad news is good news. And just we look at this from day to day, just trying to interpret what this means for interest rates. But a lot of those economic variables are starting to, or they have been heading in the right direction, and we're getting to the point now where we should be seeing more interest rate cuts or some initial interest rate cuts from these developed market central banks. I'll just look at the US. We've been pondering over that one. The global economy and global investors and global citizens have been pondering over when the US is going to cut rates for the first time. And we can even go back 6 months at the start of this year. The market was anticipating 6 interest rate cuts in the US of 25 basis points each. We, at the end of this week, we're 6 months, we're half of the year done with no interest rates. And if we look at the Federal Open Market Committee's last meeting, they issued their dot plot or their summary of economic projections, and as a collective, they were just looking for one rate cut during the course of this year. And the market, though, is still a little bit more positive, probably looking for 2 rate cuts from the US this year. And at this point in time, there's around a 66% chance, or that's what the market interest rates or forward rate agreements are pointing to, the probability of a 25 basis point rate cut in September. The Federal Reserve has 4 meetings left this year, so I'm sort of penciling one in a first rate cut there for September, and then we'll wait and see if we can get another one before the year is out, maybe a pre-Christmas present of another one in December. That will depend on how the data plays out later in the year. So a rate cut or 2 from the US. I think we're edging closer to the time where the Fed will concede and start cutting rates. The UK, as I highlighted, that little grey bar in that previous graph, are hitting 2%. So they are likely to cut rates also fairly soon. They'll want to get past the July elections, I think, and very likely, again, I've penciled in a rate cut, first one from the UK, then in September as well. They've got 2 more meetings in the remainder of this year. The ECB, they cut rates. They were the first of the developed market banks to cut. They cut in June, and they are not going to embark, and they've highlighted that as well, they're not going to embark on a rate cutting spree here at every meeting. They'll also look to see how from this point, they probably expect to cut rates maybe once a quarter. So we could likely expect another rate cut from them also in September, if not October, very soon thereafter. The Bank of Japan, they've been putting up rates, or they put up rates for the first time in many decades. They're also not going to be on a rate hiking spree, but they would potentially look to normalize rates there a little bit more over time, so they are more likely to put up rates in contrast to the rest of the global economy. On the local front then, that green bar, the repo rate on the top, we have the Monetary Policy Committee has 3 more meetings this year. They've got one coming up in July. Not likely to cut rates then. Again, penciling in September for a first rate cut from the Reserve Bank. All of these banks, central banks, are not going to go on a rate cutting spree. We're not going to go back also to 0% or the bottom of these cycles where we came from. It's very likely to be a much more shallower cut in rates over time. Excuse me. So we would expect a few rate cuts here, and I'll highlight now the Reserve Bank. They are, I think the stars there are aligning for that rate cut, as I say, in September. If you look at the Reserve Bank's model, and if you look at that chart in the center, top center there, where their quarterly projection model is indicating that the repo rate might go in the coming years, they are looking at that. If you consider the repo rate at 8.25, the expectation for the end of this year, and I'm going to round it off to the closest there, call it say 7.75, would look to 50 basis points cut in the repo rate this year. But going out to 2026, the indication, the models point, pushed out a level of 7.33. So that's not too much more rate cutting or central bank policy easing in the next couple of years. I think, as the governor has said, the model is the model. It doesn't dictate policy, and things may play out differently over time. So that's not to say that's exactly how it's going to be or play out. But the message I think to take away here for the SARB and for the other central banks is that we're not going to go back to where we came from. It's going to be a much shallower cut in interest rates here, and we shouldn't expect dramatic relief here in terms of monetary policy easing. For the Reserve Bank, though, I think they look specifically at 2 key things. One of those is their inflation forecasts, and if you look on the right, that pillar on the right, what the quarterly projection model is telling them from the current CPI, headline CPI that we've got of 5.2%, we're expecting, or they're expecting, that the repo rate will moderate, not the repo rate, the inflation rate will moderate to around 4.7 in the fourth quarter of this year, get to 4.6 in the first quarter of next year, and then hold its own at around 4.5% for the remaining quarters of next year. That's the midpoint of the target range. That's exactly what the Reserve Bank would like to see, and that is their expectation. They have a two-year window that they look at in terms of their inflation targeting and forecasting. So one could tick that box that things are going to play out very well there on the inflation front, barring any shocks, but they have a forecast and it's heading in the right direction. The other point or variable or item that they look at is inflation expectations. And that's very important if households, labor, if businesses have a view that inflation is going to be high or higher or going higher, they're more likely to spend now rather than later, given that prices are going to go up in their estimation, and that in itself drives inflation. So in wage setting agreements as well, if you've got a high expectation of CPI, you're going to go and pitch a higher level of wage growth going forward in your bargaining. So inflation expectations are very key for actually how inflation ultimately plays out. The last quarterly reading we got from the Bureau of Economic Research, who run the survey, was, as you can see there, for inflation inflation expectations were around 5.4 for this year, 5.3 for next year, and that's still way too high for the governor. He repeats almost at every Monetary Policy Committee meeting that he wants to see inflation expectations anchored at the midpoint of the range at 4.5%. So we've got the one side of the coin, the inflation forecast looking positive, but inflation expectations are still too high. We'll get another reading from the Bureau for Economic Research pretty soon, and hopefully that's improved, and maybe it will have improved enough to give the Reserve Bank a little bit of leeway or a little bit more confidence to cut rates for the first time. And as I say, penciled in maybe September as that first occasion. So with that backdrop and with the Government of National Unity, I think there's a couple of provisos or minimums that we're going to need from this government to sustain that level of optimism and to take us forward and to drive growth higher, to improve our standing on the global stage. Remember, our bonds are sub-investment grade rated by all of the institutions, rating agencies. So there's a couple of minimums that we'll need. And one of them is that the Reserve Bank stays independent. It monitors and enacts monetary policy without any interference from politicians or anybody else. So I think that is that's a non-starter. That we can't not have the independence of the Reserve Bank. We also need the judiciary to remain independent. I think we've been encouraged by some of the developments this year that no one is above the law. Everybody gets their day in court and has access to the judicial system, but we can't have any political interference in that as well. So independence of the Reserve Bank, independence of the judiciary, and really the Constitution needs to remain sacrosanct. No meddling or tampering with the Constitution, and just along with the rule of law, that all of those rights are maintained that we have in the Constitution. So those are some, I think, clearly we need to have those as an absolute minimum. And then we need the government. We've been embarking on a path of more fiscal discipline. We have a significant level of sovereign debt. In textbook terms, one could even consider it that the country is in a public debt trap. We just have so much debt that we need to finance, and a lot of that financing expenditure or the debt servicing costs, those interest costs that we have to pay, just eat into all of the revenue that we get and the opportunity that we get to spend within the economy. So our National Treasury and government has been embarking on a path to get to a balanced budget, a primary budget that's before those interest expenses. And in the quarterly bulletin released Thursday, we just saw that the government or the Reserve Bank, not the Reserve Bank, the Treasury has achieved a balanced primary budget for the first time. But we need to, they've got that fiscal discipline, and we need to see that maintained going forward in whatever shape or form, whoever the finance minister might be, that we have that continuity and that absolute commitment to getting our budget deficit down and reducing our level of sovereign debt. We need to do that so that we can free up resources to actually invest into the economy and into the broader society. Some of the initiatives like Operation Vulindlela has had some positive outcomes. We need more of those, and any other kinds of initiatives that are focused on growing this economy. We also need policies from our new government that are investor friendly, and that's investor friendly or friendly to foreign investors and to our own local investors as well, to business. We need to try and induce as much investment into this economy as possible. We saw from that graph earlier around the growth graph on just ahead of 2020, what investment into the economy can do. And we achieved growth rates there of above 5% for a couple of years. So anything that we can do to inspire investor confidence and draw in capital into this country and into the economy has to be lauded, and we need more and more and more of that. But ideally, we've had good plans in the past. We're not short on good plans. We need to actually see those plans playing out and being executed on the shoproom floors, on the deep within the economy, and actually get those plans into fruition. So one can't say it enough. We need to see that execution coming through. If we get all of these things, we're going to get the growth in this economy that we so desperately need. Households will be more positive. Businesses will be more positive. And in that respect, they'll go out and spend, they'll demand, they'll invest, they'll build factories, they'll hire more people. And that just comes from, greater confidence in the economy and where it's going, greater confidence in the running and the governing of the economy, and that will attract the local investment and the foreign investment. If we, play our cards right over time, we can see the grey listing disappear. We can hopefully see our bonds rated as investment grade once more, and just see that flow of funds back into the economy that we've seen flowing out of our economy, or just a lack of any desire from global investors to bring funds to these shores. So all of that, if we've got more money from a more balanced budget, or even a budget surplus, not beyond the realms of possibility. We've seen a budget surplus, but it was many, many, many years ago. But an improved budget position, whatever it is, we can spend more on the infrastructure, and we just need to make sure that when we switch, hit the switch, the lights come on. When we open the tap, the water comes out. When ships arrive at the ports, we can offload and unload goods, and that these things just work, that the roads work, that the rail system works. Just that infrastructure alone, if that worked, we would have a much higher level of growth. So there's much to do for the incoming government and parliamentarians, but a lot of, if they get even a little bit right, we can start making substantial inroads. Getting growth up definitely improves the employment rate. We will see more and more people being employed as we get that growth and as growth accelerates. As the investors looking into the strategy, I think there is a lot of optimism, but on the ground, not a lot's going to change immediately. We have, all of these growth ambitions, but it's going to take time to actually get to higher levels of growth. And a lot of time still has to pass before things change markedly from where they are. And I'm going to talk to just investment strategy, and whatever the political outcome is, and whatever the positivity is, it's not unpatriotic. to think that, within one's investment portfolios, you still need to look offshore and include global equities as a part of your investment portfolio. And that's for a number of reasons. One of them is just purely choice. On the local market, we have a limited offering, and I highlight just a couple of examples there. Maybe in the oil space, if you want to play the oil story, all you really have is Sasol. Excuse me. But on the global stage, you've got many, many more opportunities. Locally, in terms of luxury goods companies, we only have Richemont. There are many, many other big, key, large cap, global luxury goods companies that one could invest in. And there are other examples there in the communication space, technology, pharmaceutical space. So choice, diversification is one of the key reasons to consider, including offshore equities in your portfolio. And as I say, choice. If we look at one of the major themes that's playing out in the markets, the equity markets this year, is around artificial intelligence, semiconductors. There's no real way that we can play that theme if one wants on the local economy. One has to go offshore for the likes of the Nvidias and the Microsofts and the Metas and the like. So choice and diversification is one reason. Another reason is also the rand. Now, we can have a positive outcome for government, but we still have two major structural deficiencies, I think, or weaknesses in the currency that are behind the currency. One is that fiscal deficit that I talked about. It's going to take a long time until we can actually get a completely balanced budget, or where we don't need to go to the markets, the international markets, the local markets, for funding to fund our budget. It's not to say we can't, successfully maintain a small budget deficit over time, but we definitely need to see an improvement in that, and very specifically need to see a reduction, a dramatic reduction in debt. But that is also going to take time. So we're very likely to still have a fiscal deficit, a budget deficit for times to come. And the other thing is that we're still importing more than we exporting a lot of the time. We are running a lot of trade surpluses. So trade surpluses are good, and that's contributed positively to the current account. But in essence, we're still, when engaging with the rest of the world, we're still spending more than we're getting in. So more a case for the current account than the trade account. But we're running a current account deficit as well. So that current account deficit, along with the fiscal deficit, I think are two structural weaknesses behind the rand. And in years to come, that might change. But we've seen over the longer term, the rand is on a depreciating trend. If one also considers, just again from a textbook point of view or textbook theory, we're running our inflation rate just highlighted at 5.2. If we consider our trading partners, let's use the US for example, their inflation at say 3.2, or Europe, just above 2. Our trading partners, China, their inflation rates are lower than ours, and that in itself should see a depreciation in the rand over the longer term. We do have these bouts of extreme positivity and negativity. We see the rand spike up, we see it spike down, but this chart over the last 30 years shows you the longer term trend to depreciation in the currency, and I would expect that trend to continue over the longer term. So while it's not unpatriotic to look offshore, and it's not unpatriotic to believe that the rand will weaken over time, but one should consider then investing some of part of your investment portfolio in global equities. Just looking at the JSE, and just highlighting I did highlight that we did almost reach a new all-time high. So the local equity market has performed positively. Maybe it hasn't shot the lights out, but it has shown some positive returns in rand terms. But if you look at it in dollar terms, and I've just stretched this graph to 10 years, comparing the JSE versus the S&P 500 in dollar terms, in hard currencies, the local markets added 51%. The S&Ps added almost 170%. So you definitely want to look to the offshore markets as well for your returns within your investment portfolio. Looking at just closing out here, some of the global markets, the US equity market, as we come to the half year now, it's probably, I think, made somewhere around 31 new all-time highs this year. European equities also making new highs. Japanese equities, after decades as well, have recovered very nicely. So we have seen, there are opportunities still, that one should be looking at in the global markets. I've highlighted or reflected there the US bonds interest rates over the last 5 years. These are 5-year charts. They are elevated, but one would expect to see some decline in interest rates within the US, and that could present more opportunities also in the bond markets offshore. One last word on commodities, just to throw those into the mix. And if you look at the chart in the middle there, just at the Bloomberg Commodities Index over the last 5 years, we have seen commodities as a complex, in aggregate there, declining, prices declining as global growth has slowed and demand has waned for commodities. But unless one plays commodities on a global growth story and buys an index like this, one can look to the individual commodities. Each of those has a different story to tell. Each one is in their own market with its own supply and demand fundamentals. And that tells a story or gives you some kind of pointer to what one should be looking at in terms of individual commodity plays or individual commodity company plays within the investment markets. Those 3 graphs on the top just reflect platinum, palladium, and rhodium. Those prices have come off substantially. It doesn't look like they're going to really recover anytime soon. They have been impacted by the proliferation or the increase in the number of production, or the increase in production of electric vehicles, and the lesser need globally in the vehicle industry for catalytic converters or the likes of platinum and palladium in those catalytic converters. So there's that's a big key element of our one of our key exports. So that doesn't paint a positive picture there. Iron ore, another of our key exports, those prices are also rather subdued of late. And then coal in the bottom middle, also one of our key exports. Those prices are similarly at low levels, and that's partly also because of the pariah status of coal in the energy complex and the global drive to renewables and the like. 2 beneficiaries, though, or 2 positives, have been gold on the middle left there. Gold has benefited from central banks around the world looking to boost their reserves and diversify a bit away from the dollar. So there's been a strong move to shore up more gold in reserves, and also the prospect then of globally lower interest rates, or lower interest rates in the US in particular, driving up the price of gold. So that's been a positive and positive for our local exports. But again, part of the problem with our exports has been that we haven't really benefited from many of the super cycles, the past two super cycles in particular, in that we've really not helped ourselves in any way by we've not managed to boost production. We've put all kinds of political and other obstacles in the way, labor issues and the like, safety issues, many elements there playing a part in us not actually managing to produce enough of these commodities in the good times to export and really make the most of those super cycles and those commodity booms. Copper is the other beneficiary there, I think, of the whole AI revolution and the need for data centers and semiconductors, and that's boosted the need for copper in all of those environments. So when investing in the markets and in the commodity space, look to the outlook and the potential for the different commodities. If you're not playing the potential pickup in growth in time or demand for commodities from a pickup in global growth. So I said that was the last word, but the last word is maybe just about your overall investment strategy. I think with the government coming in, the new government coming in, one should still stick to your current investment strategy. Although we saw a very big pickup in the likes of the banks, for example, that didn't change their earnings. Their earnings didn't change overnight. It was just a quick re-rating in the markets, and that could disappear just as easily. The positivity is going to play out over a longer period of time, as I mentioned, in hopefully better growth, hopefully better earnings for companies within the economy, and those earnings will then translate into higher share prices, more positivity, lower interest rates on the bond side. But at the moment, one should stick to one's investment strategy and watch, monitor, and invest for the long term, but keep an eye on those developments and how they might alter the longer term landscape for investors locally and abroad. I've talked about interest rates and equities. I think one should consider all of the asset classes when investing and looking at one's investment strategy, particularly for the longer term. You're going to need income producing assets. You're going to need growth assets. And each person, each individual will have their own strategy. But one does need to avoid all the tips and the fads. We've seen some great individual share price movements, but if you're sitting having your nails done and the technician tells you you really should be investing in Nvidia, then maybe that's a time to start worrying. But just avoid all those fly by night kind of opportunities. Not to say Nvidia is going to fall in a heap or that Nvidia is a fly by night stock, but I think you get the drift there. You really do need to understand whatever it is you're investing in. If it's a share, what the company does. If on the bond front, you need to understand how bonds work. If you're looking at a structured product or whatever it is, you need to fully understand what that investment is all about before you invest in it. And that's really, I think, a 101 lesson there as far as investment goes. And then really finally, I think be vigilant for those opportunities that might come from a new government, maybe new policies that they put in place, where that opens up growth opportunities within the market, within sectors, within industries. That might give you an indication into where you might want to look to move funds or adjust your portfolio slightly. But continue to invest for the longer term, and by and large stick to your investment strategy. Thank you very much.